Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're looking deep dive into comparison. Did the S&P 500 just get that much better? We're going to do a deep dive comparison to the NEOS SPYI, the NEOS S&P 500 High Income ETF, and we're going to put it up against the brand new, the JPMorgan ROCY. Now, we've been doing a lot of comparisons on our show lately. And a lot of people have been putting out, different comments in comments below saying, well, I like this fund better. I use this fund. Tell me about this one. How do these two compare? Well, this actually came from a viewer and said, I was a heavy JP Morgan fan. I bought all the JPIs. I bought the JPQs. But they came out with this new ROCY and ROCK, or excuse me, ROCQ. And are these just as good, or are they better? What makes the differences? So I wanted to do a comparison between SPYI and ROCY to see which these two, are they doing what we want them to do? Is which one's better to use? What are we looking at in retirement? So the core question is really, did the S&P 500 just get better because JP Morgan made changes to their funds to keep up with NEOS, or did NEOS make changes that'll make it even better? We're going to take a look at it today. And again, I want to thank all of the subscribers that we just added on. We have added a record time, well over a couple thousand new subscribers. Also, Patreon. Man, I can't believe you guys really support this channel. Great. I've had a lot of new members joining on, and things have been going well. And also, you can go into our Patreon and you can get our new coffee mug, the Retirement Made Easy Living on Dividends coffee mug. It's there. Shipments are coming in of the fugs that we just made. It's really just something to help the channel along. Nothing great, nothing spectacular, but we got our new coffee mug to go ahead and help you just advertise the Retirement Made Easy. So what I wanted to do first was really set the landscape. What is going on? What's happening? And just basically beyond the standard indexing. The problem, the yield problem that we see with the S&P 500. Now, the S&P 500 was never really designed for income. It wasn't designed to live off of, even though they do have a lot of dividend paying funds. The traditional S&P 500 really only delivers about 1.3% yield on a yearly basis. That's leaving income-seeking investors striving for monthly cash flow. So SP 500 was always one of those that was buy it, set it, forget it, let it roll, and you're going to see on average about a 9 to 10% growth each and every year, even in good times, bad times. That's an average over time. So the old trade-off, historically investors were forced to sell shares or shift over to bonds and chase the dividend stocks that just generate that regular income. Well, the new solution that came out, and we say new, this is just the new current way of the option overlay ETFs of the S&P 500 equities and the layering of sophisticated call writing strategies on top of all that, delivering high monthly distributions while staying connected to the equity market and the equity growth. So basically what we're looking for is equity participation and high current yields. It's the best of both worlds, and that's what we're trying to find. Now, a lot of people have already grasped onto this, and I know a lot of people out there say, what are you talking about, Doug? There's people who don't really are getting into the retirement, don't really understand what they need and what they want. And this was the first thing I wanted to lay out to people is the standard index does what it's supposed to do. It grows, it grows on a regular basis, but doesn't look at the yield, doesn't look at the income side of it. So the two contenders that we're looking at today is the NEOS S&P 500 SPYI. It's really become what I call the new king of the S&P 500 high income ETFs. Now we're going to do something here. We're going to look at JPMorgan ROCY. This is a new fund from JP Morgan. It's kind of what I'm going to call a old strategy in a new package. So don't get too crazy about it just off front. SPYI launched in August 2022. It has a managers of the NEOS investments. The strategy is covered call via the SPX index. Okay, so it's doing covered calls on the SPX index. It's established battle-tested double-digit monthly yields and tax efficiency structures. Now their distributions are around 12%. When we go over to JPMorgan's ROC, this one's newly launched, and we'll get to that when I pop the hood here real quick. Now the manager is going to be JPMorgan Asset Management. Their strategy is a call spreads overlay on the S&P 500, so it's a little bit different what the NEOS is using. They're using a lot of derivatives team. They're using derivatives, so they're using the Hamilton Rainier's derivative team. It's a high yield but upside participation. And I put that in there for a reason. That's going to be the big difference between these two. And they're using the latest quantitative design. Now, the 7.4% yield is actually a lot of misleading. And I'm going to leave it at this. Is just I'm going to clarify everything I'm telling you. We're not trying to tell you wrong in any way, shape, or form. But realistically, this is what you're looking at into two different funds. So let's go deeper into NEOS. Most of you already know the NEOS family. You know what they've done here. So what we have is $10.02 billion under assets. Now, why do I always talk about that? Because when you get above $100 million in assets, you are pretty liquidity. You're safe across the board. Now, I'm not saying a fund can't go down, but you have plenty of time if you watch the asset markets that you to get in or out or whatever you need to do. The expense ratio is 0.68%, about average for this type of fund. Shares out, 189 million shares outstanding. Now, the dividends, looking at the past just 12 months that they've done, they've paid out $6.26 in dividends for right now at the price point of $11.80. Now, if everyone understands the percentage yield, that thing changes almost by the minute as the price of the fund goes up or the price of the fund goes down. It's just a mathematical system to give you a number. That's why I don't chase yield. That's why I don't always just look at yield and say, whoa, big number, we're all set. That's not the true factor. The fund does pay out monthly. Okay, it has a running daily range about $52 to $53 with a high of 54. So we're really at that high peak right now of the fund. Now this one I said came out August 30th of 2022. So realistically, we are almost 4 years old on this particular fund. Now, year to date, we see the price performance. We've seen the drop off that we had in April. We've seen the recovery back. We now see what we call the W. When we had the different operations of the war coming in play and different things like that, we had the tech drop off. We have a W. It dropped down, came back up, dropped down, and now we're on the backward coming back up. So we always watch these charts of where the fund's falling. Now for performance, this is the big one here. Because we have time underneath this fund, this fund has, like I said, almost 4 years into it. Since inception, it has an average of 14.60% total return. This is the number I watch the most, 14.6% over the 4 years. Over 1 year, it's 20.21. Year to date, 6.31. And in 1 month, 0.28%. So this ties into multiple pieces. 1, what is your yield? 2, what is your growth to give you total return? Okay, so when we take a look at right now, with a 1.09% growth, you're really talking about a 5.3% income yield so far. But on average, this thing's getting about 14%. So we're going to see this thing have an average, realistically, of about 2 to 3% of growth. Not a lot of growth, but that's just the machine is designed for income. Now, JPMorgan Equity Premium ETF, this fund, start right off bat, came out March 18th of 2026. Okay, so realistically, we're only looking at one quarter. We're looking at 3 months old. In 3 months, the fund was able to develop $246 million. If I was really good at math, I'd tell you straight out, that's almost about $1 million per month. I'd give you something a little more to it, but we're going to call it right now. I'll put about $90 million a month it added into the fund. Expense ratio, 0.35, about half the price of what NEOS is at. They have 4.6 million shares outstanding. Now they've paid 88 cents in distributions. Now remember, because this thing had to get its wheels rolling, had to get things rolling. It didn't start paying dividends. The next dividend was June 1st. Okay, so we got just probably the second dividend totally paid. Monthly payouts. Price range $53.36 to $53.86. So about the same price as what NEOS is paying or playing, with a high of $54.88. Now, we see the April drop off. We get that. But look at the end. The W is really not there. If you want to call that a W, it doesn't have the middle spike. It stayed flat and now it's coming back up. Now, we don't have a lot of data with this one, and this is why I'm saying this is what we have to be careful with. We don't have inception time. We don't have year to date. All we have is 0.97% total return so far in the past month, and we have a 7.72% growth. So the fund is showing some additional growth to it. Now, I know you may be sitting there saying, well, this is stupid. You can't compare apples and apples. What we're going to do is we're going to break this thing down in the exact same time frame to give you a better idea between these two funds. But what we're first going to do is what the actual little things that we can look at. The cost of ownership. That 0.68 expense ratio, okay, versus that 0.35 from JPMorgan. That's literally half as much. So that means you have more of your money going to work in a JPMorgan ROCY than you do in the SPYI. They are both active style management. So you're getting apples for apples. But that advantage that you're getting a lesser cost to operate a fund. Now, everything I show you will have these costs built into it. But with this already having a lower cost point to it, it makes JPMorgan ROCY a definitely very, very big interest out the board. Now the strategy breakdown, the options overlay. SPYI, the data-driven covered call, it buys S&P 500 equities as a core holding. Now this is what a lot of people get this misunderstanding of this. They actually buy the S&P 500. Okay, they will buy those equities and hold them, trying to get that is the growth factor of their engine. Is the S&P 500 actually going to go up? What's going to happen? They are then going to turn around and sell SPX index call options to collect the bigger premiums. Okay, managers actively adjust the strike prices. Now, not 100% of the portfolio is covered. This is a big factor, and this is where a lot of the people get this wrong. They think the SPYI uses 100% covered call on all of their equities across the board, and they don't. Realistically, these guys use about a 70 to 73% of their portfolio is actually covered. Okay, so that's leaving a small portion uncovered for additional growth. So you have the equities out there, plus you have index working accordingly. So it's a balances the premium income with room for that NAV growth. Okay, so they have the optimistic and they have the writing that leaves a portion of the portfolio uncovered for pure equity upside. And that's how they're generating their growth. A little bit smaller because they are income generated first. They're looking, how do I make income? But I also want growth, and that's why they leave part of theirs uncapped. Now, ROC, the JPMorgan one, uses a totally different way. It still buys the S&P 500 equities as core holdings, but it sells call options and collects those premiums. It buys further out of the money call for the upside protection. This creates a defined corridor of market participation. Built-in reparticipation in the S&P 500 surges, engineering that JPMorgan's derivative desks. Okay, so what they're working with is they're not using either. They're not using their whole portfolio. They're using the equities to help grow and using the further out of the money calls as an upside protection. They're designing theirs to be more of a growth with an income bonus versus income first, and whatever we get, we get. These guys are trying to balance between growth and income. ROCY's long call leg provides an upside insurance that standard covered call writers don't carry in a runaway bull market. So really what we're saying is if the market takes off, you're going to get income from SPYI, no questions asked, but you're not going to see the growth. While ROCY is going to give you that bigger growth side of it with a good amount of income. I can't say they're going to give you as much income as SPYI will, but they're giving you a good quality income. So two totally different strategies working out there. So it comes down to the question is, do you want income or do you want growth as being your first option? So how does that compare right now? Well, this is coming directly from both companies, NEOS and then JPMorgan. So the NEOS SPYI, and I agree with this one, has an average about 12.1% for income. JPMorgan is saying we're targeting right around and working with becoming up around 11.93%. Huge difference here in what I'm saying is there's a big difference between these two. We are so close to being 12% for either one. Now we start saying, hold it, if I can get 12% with JPMorgan and get growth, doesn't that make a better overall portfolio? Doesn't that make a better piece? NEOS is in my portfolio. I'm not going to tell anybody different. I have NEOS SPYI in my portfolio. I am not sponsored by them. I don't do anything with them, but I do have it. I do support it. I do tell people to buy it. It's a very, very good piece. They're trying to maximize that income. But with JPMorgan coming in at 11.93, they're not too far behind. And when we look at the SPY, the index itself, only at 1.3, these guys are gaining basically a good 10 to 11% growth over what SPY. So their systems work. And like I said, they spread the portion of the premiums, buying those upside calls, less income net distributed, and more growth potential. Well, if we're talking these kind of numbers, and these numbers continue to come out the way that they said that they are from JPMorgan, I would take the growth side of what NEOS is doing. NEOS needs to make some changes to be able to do this. The growth of the funds. You saw it earlier. I show it again. SPY has a 1% growth year to date. ROCY has a 7%, 7.72% growth year to date. That's a almost 6.7% growth. Okay, more than SPYI is doing, and we're not giving up much income. So ROCY is very, very attractive at this point in time. So the growth and upside capture. SPYI's optimistic approach does not write the options on 100% of the portfolio. We already talked about that. The managers read volatility signals and decide that coverage. Leaving of the portions holding are pure equity for growth. Now, they're not doing anything else. They're just letting the equities grow, which is why the growth is so small. Okay, so they're not, like I said, they're not using 100%. I'm putting it right in there. They're about 20, realistically, between up to 30, I'm going to call it 30%. About 30% of their portfolio is normally open to grow. When you look at ROC, the spread calls that they do, sells a call to collect the premium income. buys further out of the money calls for that upside insurance. So they're buying farther out saying, hey, this is my next one. Let's get the market up to this price so I can sell this to create the income. In a rapid market surge, that reparticipating in that S&P 500 gives them the gains that they're trying to get. Now, this is where the scary part to me comes into. Are we going to have a bull market? Are we going to have a market that's going to continue to run? And so am I going to get my income and my growth, or am I going to cut my growth off if the market does not get to that higher out of the money side of it? Both strategy answer the same problem, but ROC's long call leg provides the built-in rally insurance that traditional cover call writers simply don't have. Hopefully I explained that properly to you, that you understand. SPYI is just waiting for a select group of funds, 30%, to grow and raise, while ROC is looking out down the road saying, I want the whole portfolio to raise. I want my whole S&P 500 to gain. That's why you see the bigger growth. Total returns. Now this is where I'm going to put the rubber to the road. Both of them, year to date, 6.31 to 9.24%. Okay, now we're talking a little, just a hair under 3% difference between the two funds year to date. Let me show you the chart. The reason why I showed you this chart, we went back and we snapshot the past 3 months. Okay, so this gets in where ROCY opened up. So realistically, I cut it off just a hair before that. SPYI had a little extra time into it. I don't think it's making any major changes in the actual outcome of the numbers. When you see in the brown, the ROCY from JPMorgan came out, the patterns are identical to each other. The patterns are doing almost identical to each other. So that's a comfort for me that they both are working in the same underlying. There's no leverage. There's nothing else to mix with this. They're running right along with it. They both drop at the same time. They both recover about the same time, all the way through. But what shows me is the strategy that ROCY is doing that's gaining them that extra 3% so far in the, what I call the last 3 months, which for them is going to be their year to date. What we're seeing across the board is they are gaining the extra growth, not just income. They're getting the growth, and it's a growth fund versus an income fund. So that total return focus. Now, NEOS SPYI, income first compounding. So they're expecting that 12% monthly yield reinvestment. Compounding drives that total return. The income is the engine. It's not the bonus. With JPMorgan, it's a balanced growth and yield. They come back with their yield about 7.4% plus that visible NAV appreciation with those call spreads that lets the price rise. The brokerage balances the growth alongside income. So they're trying to give you that teeter-totter both of price growth and yield contributions. So the hybrid verdict both give you a very smooth ride. The cash flows cushion the market downturns. Both stay connected in the U.S. equities. Neither sacrifices the S&P 500 exposure. But I really truly believe at this point what you're going to get is SPYI gives you a better, stronger income potential, while JP Morgan's giving you that quality balance and yield combo together. So I really can't say that this is better or worse or where we're dialing into, but that hybrid verdict gives you both that smooth ride. The next step is tax efficiency. Now we're going to talk real quick about this one because we talk a lot about this on this channel. If you're into retirement, and if you're into it and you're collecting dividends like you are myself, I'm collecting dividends, the tax efficiency SPYI is superior. Okay, their writing options on the SPX index are classified as 1256. That means the lower tax rate, 60% are classified as long-term capital gains. The maximum you can pay is 20% by the federal government. 40% is dialed into short terms. On top of that, they use return of capital, ROC. And then with the return of capital helps kick your cost down the road and the tax guy down the road. So it reduces your whole side of it, plus the tax harvesting that they do. So this is a very, very unique way that they do it so that we can eliminate as much taxable potential that we have in this fund. Now, ROCY is the biggest change that happened in these funds from JPMorgan because pretty much they've been using the strategy that JPI has always had. What these guys introduced, though, is the return of capital. They're using that return ROC, the return of capital. So that means your monthly cash received, IRS does not tax it in this year. They reduce your cost basis, and that tax clock is ticking, deferring it to a later time, later date, basically when you sell your funds. ROC is a great piece. It's a IRS service, so it works well if used properly. But like I said, return of capital can actually be what you're talking about. If you use it wrong, you could actually dip in your assets to pay the people to keep your interest, keep your yields up, and now you got opportunities to create NAV erosion. These guys have been using it right. JPMorgan seems to be using it right. So it doesn't eliminate taxes, but it does help your liability down the road. So the final comparison, for income seekers, I still think NEOS SPYI is still the top dog. And it was one of the strongest pieces that we have out there. Established, like I said, in 2020, almost 4 years into it. Their tax side of it is a big advantage for retirees like myself. And that 12% with that monthly dividend distribution yield. Now, JPMorgan ROC. This one, like I said, they're the growth and balance hybrid piece. Okay, they are really trying to get a 7.4% yield. Okay, why, everyone, you want to ask that question now? Why have I been using 7.4? That's what their actual target's right around, is targeting that plus the upside participation. Are they getting to a higher number? Yes, because the market has done actually very well. Their system is working well in the bull. But they're saying we're not going to be a bull market every day of the week. So we got to prepare for it accordingly. They do have the return of capital of that tax deferral, and they have that lower interest rate for a managed fund. So ROC, definitely a strong piece and an add-on in the portfolio. I still believe personally both of these are better than the SPY, because the SPY index only would be a foundation fund that just grow. But when you're a retiree and you need income, SPYI, I think still, because of those 4 years and the tax side of it, is still king in this category up to ROCY. Is ROCY a future player? Most definitely. 3 months into it, I've told you on this channel, I don't buy anything until we're 6 to 12 months into it, but it's on my radar. And a lot of you have talked about it. That's why I wanted to put these two up against each other. Let me know what your thoughts are. Do you like the way we present this to you? Leave a comment down below. Hit that like button up top. And again, if you're not part of the family, hit the subscribe button for sure. And also, don't be afraid. Get on the Patreon and be ready to order that mug. I'm just telling you out there, it helps the channel and it's a unique thing. I'm excited about it.
Thank you for watching.